All right, from the top of the mountain, nice Sunday workout here. All right, topic of the day is breakage penalties. Something some of you may not have thought of when you picked the term on your new mortgage. When it appears as though the central bank's going to start aggressively cutting interest rates, the interest rate curve steepens. What does that mean? That means that the short rates, 1-2 year rates, they are going to collapse, and the rates farther out the curve, 3 to 5, may come down a bit, but not as much as the short-term curve, short-term rates. So if you go with a 1 or 2 year rate, even a 3 year rate, thinking that you may move or you may need to break your mortgage, but the breakage penalty will be less and you really don't like a variable, hence why you went fixed, you may be surprised to find out that the breakage penalty on like a 2 or 3 year rate may be just as great as, say, a 5 year rate. And the calculation goes difference between the interest rate when you took the mortgage and what it is when you break it, times the number of months remaining in your term, times the size of your mortgage. That is the calculation. So someone would think, well, if I take a longer term mortgage, say a 5 year, my breakage penalty is going to be greater because there's more months remaining when I break the mortgage. That thinking is correct. However, what a lot of people fail to realize is when the economy starts to tank and the central bank starts cutting rates aggressively, the short-term rates, the 1 and 2 year, they decrease a lot more. So that calculation, as I said, the rate differential could be much higher if you took, say, a 2 year rate versus a 5 year rate, which completely offsets the other input into the calculation, which is the months remaining, meaning that you may end up with just as large a breakage penalty if you take a 2 or 3 year than if you took a 5 year. So something to think about if you think there's a possibility that you may need to break your mortgage before the end of the term and you're worried about the breakage penalty. The safest route to go is variable because it's always just 3 months interest if you need to break your mortgage. And again, some people don't intend to break their mortgage, but life happens. Unexpected things happen. They're unexpected, hence you can't plan for them. So something to think about is that it's not just about the months remaining and the size of the term when you're thinking about how big your breakage penalty may be. You also have to take into account what happens with the interest rate curve as the central bank starts to cut interest rates. Take care.